Hi all, today we are going to see about accounting and accounting process. Accounting is the process of recording, summarizing, analyzing and reporting financial transactions of a business or organizations. It involves systematically organizing financial information to provide insights into the financial health and performance of the entity. So, accounting is general terms if we say. So in this, it will be considered as a system. So what are all accounting terms are there? So it will collect and processes the financial information through the business. So that information should be reported to the users to make appropriate decisions. So the accounting process is defined is it's a process of identifying, recording, classifying, summarizing. So in this we are going to see about the process and meaning also. So in this we are main objectives so for in that accounting which we all know that we can maintain accounting records, we can create the results of operations, so to ascertain the financial positions of the business and to communicate the information to the users. So if we go with the accounting term means, so generally accounting, so the transactions are classified and summarized and analyzed to prepare the profit and loss account and balance sheet. So accounting work should be done by the senior level employees. They should have licensed or they should if they can have a consultancy to file the accounts. So these accounting information is used at the time of planning and control, and so the work is carried on from the records which are available from bookkeeping. So, if we take outsiders like stakeholders, investors, creditors, bankers, so they are also interested in accounting. So, accountant supervisors will check the books of account bookkeeper. So, that is the reason they are started preparing and presenting the accounts for the accountants. So, the accounting starts from the point where bookkeeping ends, and it is the art of putting the academic knowledge of accounting into practice. So then coming to the point of identifying process involves identifying. So first this step involves recognizing and documenting all the financial transactions that occur within a business, such as sales, purchases, expenses and investments. So here they are just identifying the business transactions of the source of a document. So they are just identifying the documents which occurring like sales or purchase or expenses or so it will occur within a business. So they are just identifying the transactions involved in that. Recording transactions. So the next function of accounting is recording all the business transactions with a systematic manner. So once the transactions are identified, they are recorded into accounting system. This typically involves entering them into journals such as sales journal, cash receipts journal, cash disbursements journal, and general journal. So in these recording transactions, they are just involving and they are identifying and recording the in the accounting system. So in this they are entering into journal like sales journal or cash receipts journal and disbursement journal and general journal. And going with the third point, classifying transactions. After transactions are classified into specific categories such as assets, liabilities, equity, revenue, and expenses. These steps helps organize financial data and ensure accuracy in financial reporting. So in this, they are saying about so this is the concern of classification of recorded business transactions. So the transaction should be similar type at one place. That is ledger accounts we can say. So they are just specifying each categories such as assets, liabilities, and revenue and expenses. So in this, they are just classifying what all the transactions are there in this. So in that, it will just check with accuracy in financial reporting. Posting to ledgers. After transactions are classified, they are posted to appropriate accounts in the general ledger. Each account in the ledger represents a specific type of transaction or financial element such as cash, accounts receivable, accounts payable, and various accounts. So here they are saying about, so after classifying transactions, so it should be posted to the general ledger. So in this general ledger, it will represent as a transactions of financial element like cash, accounts receivable, accounts payable, and what all expenses are there in expenses account should be posted to general ledger. So they are just mentioning the type of transaction for the to represent a general ledger. Prepare trail balance. A trail balance is prepared to ensure that the total debits and credits are equal in the accounting system. This step helps detects errors in recording of posting transactions. So trail balance is the evaluating and concerning with the debit and credit balance should be equal. So if there is any errors or anything like mismatching, so it should be recording as a posting transactions. So if there is any like amount is it's not tally or it's not coming same, means you can mention suspense account in any of the debit side or credit side of the trail balance. Then adjusting entries. Adjusting entries are made to update account balances and ensure that they reflect most accurate financial information. These entries are typically made at the end of an accounting period to account for items such as accrued expenses, prepaid expenses, depreciation, and unearned revenue. So adjusting expenses or entries are nothing but, so it will update in the account balances and it will ensure that so there will be any financial information are there or not, like that. So it will be like adjusting entries means it is accounting period, so it will just occur within a made of end of an accounting period. So in this, such as accrued expenses are there, prepaid expenses are there. Prepaid expenses, which we all know, prepaid means advance payment, depreciation, and unearned revenue. So for this there will be an adjusting entries for this. So this is known as adjusting entries. Preparing financial statements. Financial statements such as income statement, balance sheet, and the cash flow statement are prepared based on the adjusted account balances. These statements provide valuable insights into the financial performance and the position of the business. For preparing financial statement, so there should be income statement, balance sheet, and the cash flow statement should be prepared on the based on the adjusted account balances. So this should be provided to the to provide insights to the valuable financial performance and should be position of the business. Closing entries. At the end of the accounting period, closing entries are made to transfer temporary account balances such as revenue and expense account to the permanent equity accounts. This process resets the temporary accounts for the next accounting period. So in this closing entries, it's nothing but, so it will comes into the end of the accounting period. So it should be made of the to transfer the temporary account balances such as revenue and expense accounts. It will be, and it will be adjusted as a balance account balances. So these are all the following statements to perform and financial position of the business. So it such as revenue expense accounts. So it will be, this is the process to research the temporary accounts for the next accounting period. Post closing trail balance. After closing entries are made, a post closing trail balance is prepared to ensure that all temporary accounts have been closed properly and that the permanent account balance are accurate. So whether we need to check the account balance, permanent account balances are same as well as. So then we can ensure that all temporary accounts have been closed properly, and we should for we are preparing this means, so this is for the post closing trail balance. It should be prepared to ensure that all temporary accounts have been closed properly, and then permanent account balances should be accurate. Reporting and analysis. Finally, the financial statements are used for reporting to stakeholders and for analysis to make informed business decisions. Financial ratios, trends analysis, and other tools may be utilized to access the financial health and performance of the business. So here the financial statements are used for reporting to to stakeholders and for analysis to make informed business decisions. So there will be some reporting to the transactions of the accounting. So that should be reported to the stakeholders and to make informed to make informed business decisions. Financial ratios, trend analysis, and other tools may be utilized to access the financial health and the performance of the business. Financial ratios, trend analysis, and other tools may be utilized to access the financial health and performance of the business. So these are all the following accounting process involved in the several steps. So thank you all. So now today uh, we were discussed about accounting process and accounting meaning of the accounting and accounting process. So thank you all. Do like, share, and subscribe. Thank you.